should you add to losing positions in your pension or your stock portfolio generally? Now, it's a psychological problem that I've often been asked to solve, both as a hedge fund manager, but also, more importantly, as somebody who's lectured on behavioral finance as a fellow at Corpus Christi College, Oxford. First, about 25 years ago, I came across this prevalent issue of people adding to their losing stock positions. Now, let's look at why you shouldn't, statistically, financially, and also why the psychological impulse happens at all. Let's start with the psychology first, and these are the areas of behavioral finance that I've covered well before I started the hedge fund. And the reason it was important is because the older I get, the more I realize that everything actually with investing is psychology. I've written about it in one of my 18 books. You can download it for free from alpeshpatel.com/links. There you go. Lots of great reviews from hedge fund managers, Bloomberg TV, Financial Times, and the like. Yours to download for free. But let me give you the highlights. The reason psychologically you want to do it is loss aversion bias and regret bias. We don't want to have had a loss. So what we do is we say, well, if I add more to this investment, then surely the average cost goes down. Therefore, it needs to move only a little bit up and I won't have a loss. Now, if you take this to its extreme conclusion, what it means is you are willing to keep putting money into it until it only has to move up, say, 1 cent or 1 penny, and you break even. You'll have spotted the problem. You'd need unlimited amounts of cash, and it's fine if you get lucky once. Okay, it's a bit like the martingale strategy in a casino. Oh, I'll put my money on black. If it comes up red, I'll just double up and add £1, and I'll keep doing that until I make my money back, which again is all fine until you realize how exponentially, if you get a string of losing trades, you can lose a lot of money very quickly, which is why hedge fund managers don't do this. So statistically, it doesn't make sense, right? You might say, well, no, I plan to just do it once, get lucky and get out. Well, nobody ever went to Vegas, got lucky once, and then just left and never returned, okay? And if they did, they continued that gambling attitude elsewhere, and they still ended up net zero or below. So the behavioral reason why you're doing it is clear. You want to avoid losses, don't we all? The mathematical reason why you're doing it doesn't make sense. It's not rational. So economically, it's not rational. Mathematically, it's not rational, other than it makes you feel good in the short-term dopamine hit, but actually longer-term irrational, assuming that rationality is not losing money in the long term. So what is the solution? Well, the only time you should be adding to those losing positions is if that is the investment strategy of dollar cost averaging, for instance. In other words, I wanted to buy $10,000 worth of Microsoft. To be a little bit cautious, I put $3,000 in this month, $3,000 the month after. Then if the price has fallen or risen, you're adding money. Now, you're not adding it because it's fallen. You're adding it because that was the strategy and it's a stock that you like, okay? That's the reason why you're adding it. Now, that's very different to, well, it's fallen and therefore I'm going to add it. Because if you look at all the things which cause a stock price to move, one of them is not Alpesh owns it or because the stock has fallen, therefore it's likely to move up. Unless you happen to have tested reversion to mean and so on, and some hedge funds make a lot of money doing that. Anyway, bottom line, in your pension, don't add to a loser. Statistically, financially, economically, mathematically, doesn't make sense. It just makes you feel a little bit better. If you want to feel a little bit better, analyze the company afresh. Now, you might say, well, wait a minute, what about Warren Buffett? He likes stocks when they fall, and because he knows he can buy more of them. Yeah, that's because the way he analyzes it is, if he didn't already own it, would he buy it at this new price? And that's a different scenario, because what he's saying is, do I like it to go forward? The fact that he already owns it doesn't make the share price move, and that's why he discounts it. So that all of that should help you make the right decision in your investing. Have a look at my campaignfor1million.com, where I teach people how to be better investors, make more for their pensions. Basically, add an extra $1 million across their lifetimes into their pensions. Have a look at alpeshpatel.com/links as well. And do please like and follow and share all of this. Thank you very much.